Alright, we are live. Everybody hear me? If you could just give me a yes. Wouldn't be the first time I did a discussion without the mic on, right? Alright, cool. Okay, so this is exactly what I'm talking about. Is, somebody wanted to, they ask a question, and let's have a little discussion about it. And, it was a multi-pronged, but let's keep it, let's keep it to this so we're not, watching long videos. So this is a question about intrinsic versus extrinsic value of an option. And, the way that, here, let's think about, define it maybe in real life terms first before we try and bridge it over into options. Okay, so let's take something like corn, all right, just a random example. All right, there's an actual value to that, right? If you don't have anything else to eat, that's what you're going to eat. So there's something physical towards that. Now, so that would be intrinsic value. Now, extrinsic value would be, let's just say, something a little more esoteric, like a piece of art. Now, it's nice to look at and everything like that, but other than the paint and the canvas and the frame that it has, there's nothing really intrinsic about that. Certainly not to the point where you would pay millions and millions of dollars for it, other than the fact that you have millions and millions of dollars and you like to look at that piece of art. So that's the difference. So that, one has a physical value, and one has a subjective value. And subjective is just that. Whatever you think it's worth, that's what it's worth. Beanie Babies. Yeah, they're, I guess you got some, little beans inside of a bear, but other than that, there's no reason why those things should have been trading for thousands of dollars, other than somebody was willing to pay that. Okay. Any questions on just kind of the definition of intrinsic and extrinsic, and then we'll move it over into how that translates over into options. Okay, so I'm not seeing anything here. That's fine, because that was pretty straightforward. So an option is made up of intrinsic and extrinsic, or can be made up of intrinsic and extrinsic value. One is if, and when you will hear this happen often, you can use intrinsic in the money, and extrinsic will be out of the money. You'll hear those terms thrown around. Okay, so now let's think about something, and anybody just throw out a stock name. It doesn't matter. But whoever gets first we get to use your example. Give me a stock, any stock. There we go, CCL. Let me make this a little bit smaller so we can have this out here. CCL. Carnival Cruise Lines, I believe. Okay, so we are looking at something. In the example, we see that we're trading 58.5-ish. Okay, so now let's look at the 50 call. Does the 50 call have any material value? Because this is going to expire tomorrow. So let's pretend that we're fast forwarding to tomorrow, and we are sitting here in the afternoon, and there's nothing going on. Sorry, Shane. Lee beat you. But it's really immaterial. So at expiration, is there any value to that 50 call? And let's just say that CCL, we're going to fast forward to Friday. CCL, we'll just go stock. See if I can keep this straight. Stock is trading, let's just say $59, and we're thinking about the 50 call. And this is for something going out to tomorrow. You're right, I changed the price on you, Lee. You're right. Because if the stock is trading 59, the 50 call gives me the right to buy CCL tomorrow at 50. Well, that has $9, and like I said, let's pretend that we're sitting here right before expiration. Now, the converse to that, is there any extrinsic value to it? There won't be any. Because why? Because the extrinsic value, we already said that if we're trading 59 in the 50 call, it's worth 9. But now let's go out to regular March options. Now here, let's pretend that we're still just trading 50, but let's look at the 60. We're going out to regular March. Let's look at the 61 calls. Those are trading for a quarter. So I'm going to get rid of this here. Get rid of this. And now the stock, let's pretend we're still trading 59, and the option we're talking about is the 61 call. Is there any intrinsic value to that? Is there any intrinsic value to that? I agree with Eloise, David, and Bob. Shane, thank you for ringing in, and keep ringing in. There's no way that we're gonna learn this stuff without kind of sticking our necks out and being wrong sometime and learning something from that. It's better to do it now in a discussion than when we're actually trading, because let's just say that we're trading 59. Well, the 61 call gives me the right on March 15th to buy CCL at $61. I would not exercise that right. Why would I exercise that right when I could just go to the market and buy 59? 59s, excuse me. So all of the value is extrinsic. Why would somebody pay for something, in this case a quarter, why would they pay a quarter for something that's trading 59? That gives them the right at 61. Why would I pay any money for that?
Right here, Steve. It is, so for me, now I look at it.
I see some people typing, that's why I'm not ringing in right now. No, you would. Look at you can go right now, and the market is 20 bid at 30 with 25 mid-market. Somebody's willing to. I bet you. I don't want to bet, but it's very possible that that this theoretically is worth 25 cents. I could certainly go in and sell it at 20 or buy it at 30. So how did I get 25 cents? That's just the market here. We see that the market, these are March 61 calls. Here's the bid, here's the offer. That's the theoretical value, which is just the bid plus the offer divided by 2. So somebody is theoretically willing to pay a quarter for these things. Why would they do that? Well, time value, but what does that mean? What does somebody think that is going to happen or may happen between now and March 15th? They think, right, there's a chance that it could go up above 61. How much of a chance? Well, the market determines that. So they're paying for the possibility of something happening. And like I said, it's up to the market. Those that think that 25 is too cheap, they buy it, and somebody who thinks it's worth less than 25 sells it. And that's why we have a marketplace, and that's where we have price discovery. So it's opportunity cost, because it's possible, not probable, that CCL goes up to 100. Well, I'd pay a lot more than a quarter for that right at that point, right? That's a home run, grand slam, and winning the Triple Crown all at once. Again, it's not probable, it's possible. Okay, so that's an example of an option that has only intrinsic value and only extrinsic value. Now let's look at another example. Let's stay here in March, and let's say the stock is trading 59 for round numbers. Let's look at the 58. Well, now we're gonna, let's see. I'd like to freeze these prices here, but we can't. Okay, let's look at the 50. Let's look at the 57. Stock's going to be trading. We're trading 58 and a half, and this is going to be the numbers are going to be a little bit off. But let's look at the 57 call. Now, the 57 call has some intrinsic value, right? It's worth something. If we were to expire here by March 15th, it would be worth $1.50, right? Because it's that much in the money. But we can see that it's trading for, right now it's trading for $2.17. Well, why? Because there is extrinsic value to the put. Or it's worth about 50 cents. So you can have intrinsic and extrinsic value at the same time. And so any intrinsic value is going to be in an in-the-money call and extrinsic value. But as we approach expiration, that extrinsic value goes away from options that are a lot in the money, and that extrinsic value goes away from options that are way out of the money. Okay, so what questions do we have on that? I think, for at least for me, when I was learning this, it was easier to remember intrinsic, in the money, I. Extrinsic, out of the money. So an out of the money option is all extrinsic value. An in the money option will definitely have intrinsic value, and it could have both intrinsic and extrinsic value depending on how much premium is left on the opposite side of if you're talking about a call, how much is the put worth? And if you're talking about a put, how much is the call worth? But in the money, out of the money, that's the way to remember it. All right, any questions on that? And I expect questions, and that's why we're recording this. So if you don't, sometimes you'll sit there and you'll listen and be like, oh, that makes all the sense in the world. I get it now. And then we finish here. You come home and you're like, I don't remember anything Mike said. Go back and listen to the video, come up with questions, and then we'll dive deeper into it. I'm seeing a couple people typing. And that's why, I try and keep these videos relatively short, so you don't have to come home and listen to an hour of me babbling on. Can you go over the example of an option of having both again? Sure. Okay. Let's look. Here we are. Let's look at. Okay, Lee, you threw out LMT. Let's look at a different example. Okay, let's look at March options arbitrarily, but we are trading a little bit above 300. So we're trading 303.92. So there is $3.92, and this is going to jump around on us because the market's open. But let's just say this is going to have about $3.90 of intrinsic value. Yet look at where the call is trading. It's trading $6.80. Why? Because there is extrinsic value on the put side. So there is intrinsic value. If we were to go out right here, it's going to be worth, let's just say, $3.90. But there's also extrinsic value. And like I said, the numbers aren't going to line up exactly because this is a live market that we're talking about. But if we were going to expire, let's pretend that it's 2:59 here Central Time tomorrow. These March 15th, if we were on March 15th, these are only going to be worth whatever we're trading minus your strike price. So in this case, $3.81. And extrinsic value is going to increase as you go out in time. Why? Because there's more opportunity for other things to happen. The extrinsic value, yes. And actually, when we get a little bit more advanced, I've actually made a tab here called the put call parity calculator. And I think that's a little much to throw in here today, but we can definitely have that discussion on how there's something called put call parity. But I think that's a discussion for a little bit later. We don't want to overflow our brains here. But yes, any option that is out of the money that has value, all of that value is extrinsic value. And that extrinsic value can trade anything. It's just up to the market. And that's where the concept of implied volatility is as extrinsic premium goes up, implied volatility goes up. And as extrinsic value goes down, implied volatility goes down. But again, I don't want to throw too many concepts into this one video. All right, so let's stop the video here.